Welcome once again to our accounting classroom. And today we are going to be looking at the topic of cash flow analysis. The statement of cash flows. Now, what is a statement of cash flow? It is one of the main financial statements prepared at the end of an accounting cycle. And the main objective of the statement is to highlight the source of cash and its equivalents and the use of cash during the period. Now, a business has an accounting cycle, and during that cycle, the business would receive cash and it would also use cash. So the business is going to use this statement to find out where does its cash come from and where the cash is going. Now, cash is considered to be the lifeblood of any business, and little can be done without the flow of cash. So if a business does not have cash, it is not much that it cannot do, because then the business will not be able to buy assets, it will not be able to pay its debts, neither will it be able to pay for any expenses that are incurred during its operation. So the business has to collect cash from the sale of assets and also from additional revenues or investment returns, and they can get cash on for interest that they may receive on any investments that they would have made. So we can see that cash is really the blood of any business. Now, there are three main categories of activities using and generating cash in a business. The first category is operating activities. Then we have investing activities, financing activities. So these are the three main categories that we will be dealing with within this course. Now let's take a look at operating activities. Now, this category of activity usually concentrates on the short-term items for which money is used or generated. And what it does, it converts the accrual basis system of accounting for short-term activities into a cash basis system. And when I talk about accrual basis system of accounting versus the cash basis system, what I am referring to when we talk about accrual basis, we are basically saying that under that particular system, whether you receive money for items you would have sold or not, you have to record them during the period because that will be considered revenue earned. And if you have an expense, like for example, you have an electricity bill to pay and it's the present accounting period. Now, whether you pay that bill in the present accounting period or not, or if you leave it till next accounting period to pay it, the accrual basis system states that that was an expense incurred in this present accounting period. So therefore, when you are preparing your income statement, you must record that expense within the particular accounting period. So that's the accrual basis system when we talk about the accrual basis system of activities. However, the cash basis system is different. The cash basis system tells us that we only record revenues and expenses when we actually receive money or when you actually paid out money. So therefore, when you receive the money from your debtors, the cash-based system says if you receive the money 2 years later, a year later, 6 months later, you record the money you receive from your debtors when you receive it. If you have, again, the electricity bill to pay, if you pay that bill next year, then you record it next year when you pay and not in the present accounting period. So that is the cash basis system versus the accrual basis system. So therefore, the operating activities will take that and convert the accrual to the cash basis system. Now, there's usually a net profit or loss generated in the period, and that net profit or loss that would have been generated or worked out using the income statement contains cash and non-cash items. So therefore, since we are doing a cash flow statement and we only want cash items, we will have to adjust that statement to reflect only, we have to adjust the net profit to reflect only the cash items. So since it has cash and non-cash items, it would have non-cash items such as depreciation, because depreciation is a non-cash expense. And it will also have things like losses and gains on sales of assets. So you make a loss or profit on the sale of an asset, that is a non-cash item. And you may have amortization of intangible assets. And so these are all non-cash related items. And someone may want to know what is amortization. Basically, it is depreciation of an intangible asset, but in accounting, we do not call it depreciation. We use the term amortization when we are referring to intangible assets such as goodwill, right? So therefore, these items are usually used in your income statement when you are going to generate profit for the period. So since we are going to prepare our cash flow statement, we have to then adjust that profit to only reflect the items that are related to cash. So all of these adjustments have to be made. The next category we look at will be, so again, the next category of activities we'll be looking at will be investing activities. Now, this category of activities concentrate on the long-term resources of the business. And when I say long-term resources, I'm referring to the non-current assets of the business. And this category looks at the acquisition or purchase of those non-current assets, or the sale of those non-current assets, and any item that is associated with payment or receipt during that period. Like for example, you can receive interest on an investment, so that would be considered and categorized under investing activities. Now, depreciation or amortization will not necessarily affect the items that fall under the investing category. Although we depreciate our non-current assets, and non-current assets are usually found under the investing, purchase and sale of non-current assets are usually found under investing activities. Depreciation are expended over the life of the ownership of the asset, and those are usually considered operating types activities. So therefore, you will find the adjustment for depreciation under the operating activities category and not under the investing activities category. Now, there are some instances where an asset may increase, and it does not always have to be a purchase to cause the asset to increase. Now, when we're doing cash flow statements, you are usually given two statements of financial positions. You have one for the current accounting period, and then you have one for the previous accounting period. So when you look at these two statements of financial positions, you can see changes within your assets, your liabilities. So whether it is current or non-current, you can see changes going on. You can see changes with your equity section. You see whether they're increasing or decreasing. So looking at the non-current asset section of these statements, you see that you have an asset either increase or decrease. We are seeing here that because an asset increases, that does not mean, or decreases, that does not mean that it was through a purchase or a sale, right? So that the assets, they do not always increase or decrease due to a purchase or sale. What could have happened is that you could have had a revaluation of your assets. So if you had a revaluation of your assets, then that can cause them to change in value. and that is a non-cash item. There's no outflow of cash when you revalue. There's no inflow of cash when you revalue. You could have also acquired the asset through a debt to be repaid at a later date. So in other words, you could have acquired the asset on credit, which means you owe someone for this asset. And you would have gotten the asset, so therefore the asset value increased. But that does not mean that there was an outflow of cash in order for that value to increase and in order for you to acquire the asset. It was through a debt. Similarly, the same thing can happen when the asset value decreases. And it's not always because it was a sale for cash, or so it could be that, again, that it was a debt collected, or it could have been that the asset would have been revalued. So the next section we are going to be looking at, the next category that we will be looking at will be the financing activities section. And this is the final category of the statement of cash flow that we will be looking at here. So financing activities. Now this category of activities will concentrate on the transactions relating to the owners and long-term obligations. So when I say it's concentrate on the transactions relating to the owners, we're talking about equity. And we know that owners invest into the business. So you would have like their shares. You have ordinary share capital, you have preference share capital, you have share premium, etc. And you also have reserves, because obviously when the business makes a profit, sometimes they transfer some of the profit that they make into special reserves, such as non-current asset replacement reserve, general reserve, foreign exchange reserve. So they can transfer some of their profit into those reserves. So obviously the value of the reserve fund will be changing over time. And also within that category, you look at debt when they call financing activities, because the company can finance its operations either through using debt, which is acquiring loans, or it can finance its activities through equity financing, where it issues shares in order to get money to finance its operations. So when we're looking at the financing activities, we're looking at all of these changes. Now this section reports the effects the associated transactions would have on borrowing, repayment of debt, and equity. So you will see that either a loan may increase because you borrow additional money, or the loan may decrease because you would have repaid that debt. So some equity of a business can increase also, just like a non-current asset. Some equity of a business can increase without the involvement of cash. So, and that is through the issue of what we call free shares or bonus shares or a scrip issue, right? So you have bonus shares and you have right issue shares. Now, right issue shares are shares that are sold to the shareholders, the existing shareholders, at a lower price. But the bonus share is the share that is offered to the shareholders, but they're free. And they may be in lieu of dividends. The company may not want to pay dividends or cannot afford to pay a cash dividend at this point in time. So what the company may do is, instead of giving a cash dividend to the shareholders, it will issue them with additional shares and issue them free of cost, which is known as a bonus share. So again, you can have your shares changing and the value of your shares changing, but not necessarily because you actually receive any cash for those additional shares, but because that the company would have issued free shares to the shareholders. Now here is a format of the statement of cash flow. And when we're looking at the format for the statement of cash flows, we are looking at two methods of preparation for cash flow statements. We are looking at the direct method, and this is dealing with the operating activities category. So under that category, the operating activities in this method, the operating activities are determined by the money collected and paid out on the cash basis system. And you also have the indirect method. And the indirect method, the operating activity section now is determined from the reconciliation of the net profit or loss on an accrual basis to a cash basis system. So the cash flows are as an indirect result of the changes in the current assets, current liabilities, and other short-term accounts. So in our course, what we will be looking at, using the indirect method when we are dealing with the operating activities section of the cash flow statement and not the direct method. So our demonstrations will be showing the indirect method when we use the operating activities section. So here is an example of a statement of cash flows. And in this example photo here, you see that we have our operating activities, and they're looking at the increases, and you can also look at decreases. Everything here is saying increases, but you also have decreases as well. And it usually starts out with a heading. So the heading usually, instead of saying operating activities, the heading is usually cash flows from operating activities. And then when we work out what our cash flows are from operating activities, we have a category here that says net cash flow from operating activities. Then the next heading will say cash flows from investing activities. And we look at all the items that fall under there, like the payments for non-current assets, the receipts from the sale of non-current assets, etc. That figure is usually a negative figure, especially if the company is heavily investing in its non-current assets. You will usually get a negative figure showing net cash flow from for investing activities. And then the final section will say financing activities. Next would state cash flows from financing activities, and then you look at the receipt from the sale of issuing shares, the payments of dividends, any money you receive from borrowing, any repayment of a loan, all of that falls there. And then you will calculate that and you will get your net cash flow from financing activities. And after you receive that, you will take your net cash flow from operating activities, subtract the net cash flow from the financing, from the operating activities. That is, if it is a negative figure, you will subtract that. If it's a positive figure, you will add it. And then you would add your net cash flows from financing activities to that figure. If it's a positive number, obviously if it's a negative number, you will have to subtract. So when you use those three figures, the net cash flow from operating activities, net cash flow from investing activities, and net cash flow from financing activities, it will usually give you a net decrease or increase in your cash, right? So if it's a negative figure, it will be a net decrease in cash. Once it's a positive figure, like in this image here, it's a net increase in cash. And then you would have your opening balance for cash and bank at the beginning of the year. You will find those figures in your statement of financial position for the previous year. So that gives you your opening balance for cash and bank. And when you put that balance into with the net increase or decrease, you get your closing balance for cash and bank. Now, this closing balance for cash and bank must come back to the closing total for cash and bank on your current statement of financial position that you were given. If you do not get back, when you take those figures and you add them together, and you do not get back the same figure in your cash flow statement as what is on the statement of financial position, it means that you would have done something incorrect in your statement of cash flow. So you need to go over it again, because that is the proof that you would have done the cash flow statement correctly when your cash balance at the end of the financial year reconciles to the cash balance, the cash and bank balance on your current statement of financial position. So this was a brief explanation and presentation on the statement of cash flows and a brief introduction to this topic. So we will be getting into some demonstrations of preparing cash flow statements. So see you soon when we look at those cash flow statements.